The stock market has over 10,000 individual companies. Some of them I own, and some of them I don't. I'm going to go over 2 companies that I'm considering adding to my portfolio. Because I run such a concentrated portfolio, the fundamentals of my companies have to be very strong. This means that these 2 companies I'm going to present to you today as contenders to be added into my portfolio are the strongest companies I found on the market. I always look for a competitive advantage, a business with strong management, and a business with strong growth. I need businesses that are in sectors that are growing and have strong tailwinds. I'm looking for businesses that grow their free cash flows, that grow their intrinsic value, and that provide value to shareholders. Any business that is unprofitable or doesn't meet these specific characteristics is automatically eliminated from my screening process. I look for compounding machines, businesses that I could buy today and they grow their intrinsic value over the next decades. So with that said, I'm going to present to you the 2 companies I have found that I'm considering adding to my portfolio. Now, the first stock on my list is Intuitive Surgical. Intuitive Surgical meets the criteria of being a compounding machine. Intuitive Surgical is the global leader in robotic-assisted surgery. What they do is they have a core product called the Da Vinci Surgical System. And as you can see on screen, this is what the product looks like. Although these machines may look a bit funny, they provide a lot of advantages to surgeons. Because surgeons can make smaller incisions, this results in less blood loss, lower complication rates, and it increases recovery time for patients. Because we have a growing aging population and the demand for minimally invasive surgical procedures is significantly growing and will continue to grow over the next decades, Intuitive Surgical is positioned to benefit from these tailwinds. They operate in over 70 countries with systems installed in hospitals and surgical centers worldwide. As of recent data, over 8,600 Da Vinci systems are in use, and more than 15 million procedures have been performed globally. Intuitive Surgical has a huge moat. Firstly, its Da Vinci Surgical System is such a sophisticated and advanced robotic system that competitors just aren't at that level yet. This company holds a patent portfolio of over 4,000 patents, and they invest continuously in R&D to innovate. Because Intuitive Surgical already has over 8,600 surgical systems installed, it's very hard for hospitals and surgeons to switch to a different platform. This would result in high switching costs and reinforces this company's moat. There's also many regulatory barriers for this company. The FDA has to actually approve these systems to be in use for surgical procedures, and Intuitive Surgical is ahead of the curve, with the FDA providing clearance for many of its surgical procedures. And as a first mover to this industry, Intuitive Surgical benefits massively. This company also has over 60 to 70% of the global market share in robotic-assisted surgery. This just reinforces the company's moat. Now we move on to the company's fundamentals. It's very important that when we buy a company, or if we consider buying a company, that the fundamentals are very strong. The company may have a huge competitive advantage, but if the fundamentals of the company are weak or mediocre, it won't make a good long-term buy. Now, looking here at the earnings of the company, you can see that this is a compounding machine. This company has significantly grew revenue over the past few decades. It also had a 23% compound annual growth rate over the past 23 years. This is insanely impressive for a company. Just skimming over a couple more metrics, you can see that the gross margin is quite good with a net margin of 28%. Its return on invested capital is 27%, which is nice to see, with a return of capital employed of 14.87%. Its revenue has been increasing over 19%, which is always nice to see. It means this company is growing and has the potential to continue growing over time. This company is not doing buybacks, however, that's nice to see because this company is actually at such a high valuation. It's trading at a PE of 78.55, which is extremely high. Looking into Intuitive Surgical's most recent earnings call, I'm going to just summarize it for you. Intuitive Surgical reported strong Q1 2025 results, marked by a 17% increase in Da Vinci procedures and a 15% growth in the install base, reaching 10,189 systems worldwide. Revenue increased by 19% to $2.25 billion, with system placements totaling 367, including 147 Da Vinci 5 systems. The company has raised its full year 2025 procedure growth forecast to a range of 15 to 17%. However, tariffs are expected to negatively impact the pro forma gross margin, now estimated to be between 65% and 66.5% of revenue, reflecting an estimate impact of 1.7% on revenue. plus or minus 30 basis points. Approximately half of this impact is attributed to the US-China trade, with the remainder stemming from the imports into the US from other countries. The company is exploring mitigation strategies but does not expect significant benefits in 2025. Despite these challenges, Intuitive Surgical remains focused on the full launch of da Vinci 5, increased adoption of focused procedures, and continued progress in building industrial scale and product quality. And that's a very long way to say that this company actually had very good Q1 2025 results. It had a 17% increase in procedures and a 15% growth of the install base. So this company is growing very fast. However, there is going to be headwinds with tariffs, but this is something to be predicted, as all companies have predicted this. Looking into what analysts think of this company, Morningstar seems to give this company a wide moat rating. It also says its fair value is at a $350 price point. The current price for Intuitive Surgical is $478, which signifies this company is extremely overvalued. Of course, Intuitive Surgical does have risk. There's many companies trying to get into the robotic healthcare systems. Although at this moment Intuitive Surgical holds the highest market share, that might change over time. The most major risk, however, is its insane valuation. So Intuitive Surgical is currently trading at a 78.62 price to earnings ratio, and this ratio is just insane for a company. The problem with paying such a high ratio for this company is that if there's any slight problem with the company's fundamentals, or if there's any slowdown in growth, this company will drop significantly. If we look at the history of this PE ratio for this company, it has dropped down to 31 at some point during 2020, but aside from that, it's always been a very highly valued company. The PE ratio of this company has been extremely high for an extended period of time. So this is a company I have on my watch list and I'm watching very closely. If I ever notice that it drops down below its intrinsic value and it's at a price ratio where it's reasonable to buy, I will definitely buy this company. However, at this price point, I'm just waiting for it to have some sort of discount, because when you're investing in a company at a PE ratio this high, you have close to no margin of safety. So that creates a very risky investment for you. But this is a company I had my eye on for a while, and I'll keep watching it and give you any updates on if I'm buying it or not. So the next stock on my watch list is Meli. So Meli, or Mercado Libre, is the leading e-commerce platform and fintech company in Latin America. So what they do is they're basically the Amazon of Latin America. Now this company has a lot of tailwinds benefiting it. So you have obviously the growth of e-commerce and the growth of online sales and fintech. And this is something that's going to definitely benefit Meli over the long term. But Meli is also one of the highest quality businesses I've ever seen. And I'm going to go over its fundamentals. So there's a few key aspects I'd like to read to you in the Q1 2025 earnings report. So the net revenues and financial income came in at 5.9 billion, which is up 37% year over year. Income from operations was 763 million with a 12.9% margin. Net income came in at 494 million with a 8.3% margin, and they had a 5.8 billion total payment volume, which is up 43% year over year, and a 13 billion gross merchandise volume, which is up 17% year over year. Now let me read you the letter to the shareholders. We have had a strong start to the year at Mercado Libre, sustaining the momentum built up through 2024. Growth continues to be outstanding across the business, with KPIs supported by strong execution and an intense focus on offering a value proposition to our users that is consistently improving and innovative. This has translated to solid net revenues and financial income growth of 37% year over year in Q1 2025. Argentina has performed exceptionally well, with last year's recovery and demand strengthening even further. This helped counterbalance the increased investment in Brazil and Mexico, and as a result, income from operations grew 45% year over year to 763 million in Q1 2025. This reflects our commitment to sustainable and profitable growth as we continue to pursue the many growth opportunities ahead of us. Now, what stands out to me in this paragraph is just how fast the growth is of this business. A business of this size growing at 45% year over year is just insane growth. And if Mercado Libre could even keep up half of that growth, it is a very, very tempting opportunity to invest in this company, especially since the fundamentals of this business are extremely strong and it has a huge competitive advantage. I want you to take a close look at the growth of this company over the years. So this company has just exploded in growth over the past decade. Now, all the way back in 2006, they were earning $56 million of revenue. And now, all the way in 2025, they're earning $22.3 billion. So that is insane growth over the years. They actually actually have a compound annual growth rate of 39%, which is just insane. So going into a few key metrics of this business, you can actually see that the gross margin is at a 46%, which is not that bad. It's actually quite a high gross margin considering they do a lot of e-commerce. And as you guys know, e-commerce has pretty low margins for the most part. The return on invested capital is quite good, with a return on capital employed also quite good at 29%. The return on equity is also quite high, 41%. What I want to point out the most is actually the growth. So the revenue has increased 37%, which is just insane. This company is growing extremely fast, even at such a large market cap, which is quite impressive to see. This company also doesn't dilute shareholders, so the shares outstanding remain somewhat consistent. And the free cash flows have just seen explosive growth over the past 2 years. So as you can see here in 2024 and 2025, they're just continuously growing their free cash flow. All that to say that Melli is fundamentally a very strong business, and it's also a business that has a very strong moat. So just to put into perspective what kind of moat Melli actually has, if we go into their earnings, you can actually see they have different segments of their business. So obviously they have their e-commerce business, which makes up the majority of revenue. I'm actually going to pull up the KPIs of this revenue and let you know them. So I'm just going to use AI just point out the different revenue streams of Melli. So actually 59% of total revenue comes from their e-commerce segment. So think of Amazon and their e-commerce, so like ads, shipping, and any e-commerce related activities. So that's 59% of their revenue. But you also have a 41% of revenue that's coming from their fintech services. So that would be any payment processing or digital bank accounts. This is actually very important because there's a lot of tailwinds that benefit Mercado Libre's fintech services. So Latin America is not as developed as the US is currently. What that means is over time, the amount of people in Latin America that want to use these fintech services are going to increase. And these consumers will be paying a lot more over time. And this will benefit Melli in a huge way because they're going to have exponential growth over time just because the consumer is starting to make more money. The consumers are starting to earn higher salaries. So these are a bunch of tailwinds that benefit Melli over the long run. And with the growth we are seeing currently, I feel like that growth could definitely be in the double digits going forward for the next couple of years. As I said before, I like to think of Melli as the Latin America's Amazon. Now, I actually own Amazon in my portfolio, but I'm thinking of adding a position to Melli quite soon. I'm just hoping the price drops a little bit more because I did miss out when it was trading at around $1,800 a share. So I'm hoping it will dip down a bit. And if I do see a significant dip in the price, I'll definitely be buying some shares of this company. I don't think currently Melli is at a bad price. I feel like it's very fair for such a high quality company. It's just I'm still a bit salty that I missed out when it was at around 1,800, and it really sucks to be paying 2,500 for a company you could have bought a couple months ago at 1,800. So I'm still a bit salty about that, but I still think this company is insane value, and it's a very high quality company that will most likely do good in the future. I should also mention that it does have quite a high PE ratio, but like I say of Amazon also has quite a high PE ratio, but you can't really evaluate this company on a PE basis just because this company is making investments in growth. In its current phase, it's investing solely in growth and not in shareholder value. So you have to consider that too when investing in a company like this. So these are two quality stocks that I do not own, and I hope you enjoyed this video. Comment any companies you guys would like me to do analysis on. I could do a full depth analysis on any company you guys pick. I do reply to every single comment, so please let me know, and thank you all for watching.